I used to think the day I paid off my mortgage would be one of the greatest days of my life. I imagined that moment over and over again. I would open my bank account, look at the mortgage balance. Zero. No more mortgage. No more $2,100 monthly payment. No more watching a huge chunk of money disappear from my account at the beginning of every month. I would look at my house and think, finally, this is completely mine. No bank, no debt, no pressure. And I genuinely believed that moment would mean financial freedom. But later, I realized something. I was wrong. Very wrong. Because at one point I owned a house worth around $380,000. No mortgage. My net worth was over $410,000. On paper, that looked great. But then a $2,800 car repair bill showed up around the same time as my property tax bill, and I started to panic. I opened my Fidelity account. I looked at the amount of money I could actually access quickly, about $9,400. And in that moment, I finally understood something I should have understood years earlier. You can be rich on paper and still be poor in cash flow. A $380,000 house cannot be sliced into pieces, so you can pay a repair bill. A $410,000 net worth does not automatically save you when your liquid cash is too low. And that is why I want to tell this entire story. Not because paying off your house is always a bad idea, but because of something much more important. Being debt-free and being financially free are not always the same thing. Before I paid off the mortgage, I had to pay $2,100 every single month. 2,100美元. It sounds like just a number. But when you have to pay it month after month, year after year, it stops being just a number. It becomes a shadow. I went to work. It was there. I thought about quitting my job. It was there. I wanted to buy something. It was there. I wanted to try a new career. It was still there. At one point, I had an opportunity to join a startup. The work was more interesting. I liked the environment. I thought I could learn more, grow faster, maybe even build something bigger for myself. But startups are risky. Income can be unstable. The company can fail. And when I thought about changing jobs, the first question in my mind was not, will I enjoy this work? It was not, how much can I grow? It was, if my income becomes unstable, who is going to pay that $2,100 next month? So I turned the opportunity down. And looking back, I now understand that the cost of debt is not just interest. Debt has another cost, the cost of fear. When your fixed financial obligations are too high, you take fewer risks. You change jobs less often. You say no less often. You are less willing to fail. And sometimes, you reject good opportunities simply because you cannot survive a few unstable months. So I started cutting expenses, one category at a time. Less eating out, less shopping, less travel. Everything went through a filter. Do I really need this? Can I delay this? Can I put this money toward the mortgage instead? Some months, after all my bills were paid, I had less than $200 left. But strangely, I still felt good. Because every time I saw the mortgage balance go down, I felt like I was getting closer to freedom. I started paying about $900 extra toward the principal every month. And eventually, paying off the house became an obsession. I stopped asking, where should this money go to create the best long-term result? I only asked, how fast can I get this debt to zero? That is a mistake a lot of people make. We turn a financial goal into an emotional goal. And once emotion takes control, math usually gets kicked out of the room. Then the day finally came. I opened the account. The mortgage was gone. Balance. Zero. I stared at it for a while. No more $2,100 monthly payment. No more bank holding a lien on the house. No more feeling like part of my paycheck had already been claimed before I even received it. What did I feel first? Not excitement. Relief. Massive relief. It felt like I had been carrying a heavy backpack for years. So long that I forgot how heavy it was. Then suddenly I took it off. And only then did I realize how much pressure had been on my shoulders. I slept better. I worried less. I felt like I had more options. And the most interesting change showed up at work. At one point, my company wanted me to take a long business trip to Ohio. In the past, I probably would have said yes immediately, even if I did not want to go, even if I was exhausted, even if the schedule was unreasonable, because somewhere in the back of my mind was always this fear. Do not cause problems. Do not make your boss unhappy. Do not do anything that could affect your income. But this time, I said, no, I'm not taking this trip. That was it. No drama. No fight. No one fired me. And I remember thinking, wait, I'm allowed to say no? That is when I understood something important. When your minimum cost of living drops, your bargaining power increases, not just with a bank, with your employer, with your boss, with clients, with life itself. You are less trapped. You are less desperate. You are less likely to accept things you do not want. I even started taking a few lower-paying shifts simply because I enjoyed the work. Before, I never would have done that, because every hour of work had to pass through one question: will this help me cover my fixed expenses? But now I had choices. And I started thinking, this is freedom. This is it. Paying off the house was the best financial decision I ever made. But that was only half the story. Sometime later, my property tax bill came due. Around the same time, my car had a problem. I took it in for repairs. The estimate, 2,800美元, not $28,000, just $2,800. For someone who owned a nearly $400,000 house, that should not have been a major problem, at least in theory. But when I opened my accounts, I got uncomfortable. I had about $9,400 in liquid money inside my Fidelity account. Meanwhile, the house was worth around $380,000. No mortgage. My total net worth was over $410,000, and I sat there looking at two numbers. $410,000 net worth, $9,400 liquidity. And I asked myself, wait, am I actually rich or am I broke? That was a brutal realization. Because net worth sounds impressive. It makes you feel wealthy. You add the value of your house, add retirement accounts, add investments, subtract debt, and you get a beautiful number. But real life does not always ask for your net worth statement. The mechanic does not ask, what is your net worth? He asks, how are you paying? The hospital does not ask, how much is your house worth? They send a bill. And that is when I really understood the difference between net worth and liquidity, between what you own and what you can actually access. You can own a very valuable asset, but if it does not produce cash flow and cannot easily be converted into cash, it is not very useful in an emergency. Of course, I could borrow against the house. I could open a home equity line, but that is not the same as pressing a button and instantly getting the money. There is paperwork. There is approval. There is waiting. It could take 2 or 3 weeks. And life does not always give you 2 or 3 weeks. Life says, your car is broken today. Your taxes are due today. The medical bill arrived today, and you have to deal with it. That is when I realized I had moved too much of my money into one large, illiquid asset. I was wealthy, but my money was trapped inside walls. After that wake-up call, I started re-examining my decision to pay off the mortgage early. My old mortgage rate was 3.875%. 3.875%. Before, I looked at that number and thought only one thing: this is money I'm losing. But now I looked at it differently. It was the cost of capital, and when the cost of capital is low, you have to ask a very important question: could this money create more value somewhere else? I had been paying about $900 extra toward the mortgage principal every month, so I ran a hypothetical scenario. What if, instead of paying an extra $900 toward the mortgage, I had invested that $900 every month for 20 years, and let's assume an average annual return of around 10%. Not guaranteed, not 10% every single year, just a long-term illustration. That money could grow to roughly 68,300美元, $683,000. The first time I saw that number, I just sat there, because the real issue was not that I had lost $900. The real issue was that I had lost time for that $900 to compound. That is the power of compound growth. Compound growth does not look impressive in year 1. Year 2 does not look dramatic either. But after 10 years, 15 years, 20 years, the curve starts changing, and time becomes incredibly expensive. You can earn more money, but you cannot buy back 20 years. That was the part that bothered me the most. I had prioritized a non-income producing asset because it made me feel safe, while giving up years of potential compounding, and it did not stop there. At one point, I was not even fully taking advantage of the employer match inside my 401k. Think about that. My company was basically saying, If you contribute to your retirement account, we will contribute additional money. And I was so obsessed with paying off debt that I wanted every extra dollar to go toward the mortgage instead. That is a perfect example of this. A decision can feel emotionally correct and still be financially inefficient. I felt good every time the mortgage balance went down, but I was not fully calculating the opportunity cost. That was the bigger lesson. When you use $1 for one goal, you are not just spending $1. You are also giving up whatever that dollar could have created in the next best alternative. That is opportunity cost. And over a long period of time, opportunity cost can become enormous. I think this is where people become too extreme. One side says, never have debt. The other side says, use leverage. Debt makes you rich. Both can be stupid when followed blindly. Credit card debt at 20% interest to buy things you do not need? That is a problem. High-interest consumer debt used to maintain a lifestyle you cannot afford? That is a problem. But a long-term mortgage at 3.875%? That is a different financial problem. That does not mean low interest rates automatically mean you should borrow as much as possible. No. It means you have to classify debt correctly. Some debt is bleeding you. Some debt is simply a cost of capital. And in some situations, keeping low-interest debt while maintaining liquidity and investing for the long term can make more sense than draining your cash just to eliminate the loan faster. Especially because over time, your nominal income may rise while the fixed mortgage payment stays the same. A $2,100 payment in year one may feel enormous, but 10 or 15 years later, if your income has grown significantly, that same $2,100 may feel much smaller relative to your earnings. This is why personal finance cannot be reduced to slogans. Debt is bad. Sounds good, but it is incomplete. Investing is good. Also incomplete. Everything depends on the interest rate, liquidity, income stability, risk tolerance, taxes, time horizon, and your personal goals. Once the mortgage disappeared, I suddenly had an extra $2,100 every month. And that is when another monster appeared. Lifestyle inflation. I started looking at cars. A BMW, around $58,000. And I thought, well, I don't have a mortgage payment anymore. That $2,100 used to go to the bank, so maybe I can use part of it for a car payment. It sounded reasonable. And that is exactly why it was dangerous. You pay off one debt, then immediately create another. You free up cash flow, then immediately use that cash flow to upgrade your lifestyle. And after all that hard work, you end up right back where you started. No extra cash. Still dependent on your paycheck. Still trapped. The only difference is that now the car is nicer. This is basically Parkinson's law applied to money. The traditional version says, work expands to fill the time available. Money behaves the same way. Spending expands to consume available income. You earn an extra $1,000. A few months later, you find a way to spend $900 of it. You eliminate a $2,100 mortgage payment. Your brain will quickly find something else that costs roughly $2,100 per month, unless you stop it deliberately. And that is when I decided I was not going to rely on willpower. Before, $2,100 automatically went to the bank. Now, I created a similar system. I just changed the destination. Right after I got paid, $2,100 was automatically transferred into investment accounts. I acted like the mortgage still existed. I did not treat that money as spendable income. I did not stare at the balance and ask, what should I buy this month? The money disappeared before I had the chance to spend it. That was one of the biggest changes I made. Because human beings are incredibly good at lying to themselves. We say, I'll invest whatever is left at the end of the month. Usually, nothing is left, or very little is left. Because when we see money sitting in an account, our brain starts treating it like money available to spend. So I reversed the system. Not income spending leftover money investing, but income investing live on what remains. I started optimizing my 401k. I prioritized getting the employer match. I continued contributing to my Roth IRA based on the contribution limit that applied to me. And at the same time, I rebuilt my liquid reserves. Because after that $2,800 lesson, I understood something. Cash is not lazy money. Cash buys something incredibly valuable: time and options. About 8 months after changing my system, I had built roughly $34,000 in cash and liquid assets. $34,000 did not make me rich, but it completely changed how money felt. A $2,800 car repair? Annoying, but not a disaster. A weak income month? Fine. A bad job situation? I had time to think. A new opportunity? I had the ability to take a chance. That was exactly the kind of freedom I thought paying off the house would create. But now I understood. Freedom does not only come from reducing obligations, it also comes from increasing reserves. Lower obligations, plus more liquidity, equals more choices. And the more choices you have, the less trapped you are. I want to make this very clear. I am not saying, never pay off your mortgage. No. If you hate debt, if having a mortgage keeps you awake at night, if your job is unstable, if you are approaching retirement, if reducing your fixed expenses would dramatically improve your peace of mind, then paying off your mortgage may be an excellent decision. Personal finance has the word personal in it for a reason. Not every decision has to maximize expected return. Peace of mind has value too. What changed for me was this. I stopped treating debt elimination as the ultimate goal. I started treating it as one tool among many. And before putting an extra dollar toward low-interest debt, I would now ask, is my emergency fund strong enough? Am I getting the full employer match? Do I have higher interest debt that should be paid first? Am I consistently investing for the long term? Is my liquidity too low? Am I sacrificing too many options just because I want the emotional satisfaction of saying, I am debt-free? Those are the questions I should have been asking from the beginning. Before, my goal was simple. Mortgage equals zero. Now I am no longer obsessed with zero. My new goal is to build a financial system strong enough that my assets can help support my life. I want a large investment portfolio. I want cash reserves. I want assets that can produce income. And ideally, I want the returns and cash flow from those assets to gradually cover my financial obligations. That is a different kind of freedom. Not, I owe nobody anything. But, even if I have financial obligations, my assets are strong enough to carry them. To me, that mindset is much more powerful. If I had to reduce this entire story to one lesson, it would be this. Do not optimize only one number. Do not look only at debt. Do not look only at net worth. Do not look only at investment returns. Do not look only at income. Because you can have a high income and still have massive expenses. You can have a high net worth and very little liquidity. You can be debt-free and own almost no income-producing assets. You can have a large investment account but carry financial obligations that are too heavy. A strong financial life comes from balance. Income, expenses, debt, cash, investments, liquidity, risk tolerance. All of those pieces have to work together. I used to think the day I paid off my house was the day I won the financial game. But in reality, I had only completed one level. I exchanged debt for peace of mind. And that peace was real. But then I learned, a $380,000 paid-off house could not pay a $2,800 repair bill for me. A net worth above $410,000 did not mean I had a lot of accessible cash. A 3.875% mortgage was not necessarily the worst enemy in my financial life. And the extra $900 I was paying every month could carry an enormous opportunity cost if it meant giving up decades of compounding. In the end, the thing that changed my life was not the mortgage disappearing. It was learning what to do with the $2,100 that became available every month. Instead of buying a $58,000 BMW, I put that money to work. Instead of allowing my lifestyle to expand, I automated investing. Instead of putting every extra dollar into a house that already dominated my balance sheet, I built liquidity. And that is when I understood. The house did not create freedom for me. Cash flow created freedom. Liquidity created freedom. Productive assets created freedom. And most importantly, the ability to choose is freedom. So if you are aggressively trying to pay off your mortgage, I am not telling you to stop. But before you make the next extra payment, sit down. Take out a calculator. Do not make financial decisions only with emotion. Ask yourself, is this money actually buying me more freedom? Or is it just making me feel safer? Sometimes those two things are the same. But sometimes, the difference can be hundreds of thousands of dollars. And if you refuse to do the math because someone told you all debt is bad, while your emergency fund is empty, your investments are weak, and you are leaving employer match on the table, that is not discipline. That is intellectual laziness. Money does not care about your feelings. Math does not care whether a decision feels emotionally satisfying. If your numbers are wrong, the consequences still show up. Make your money, serve your life. Do not spend your entire life serving your house.